Welcome to Investing Basics. This is Unpacking the Asset Class, and today we'll have a look at equities in a little bit more detail. Before we begin, it is quite important to note that shares are inherently the most risky asset class, and as such returns aren't always guaranteed. Shares come in two forms, that is unlisted equity and listed equity, but due to the illiquidity of the unlisted market, we'll purely focus on listed equity in this video. Equities have a broad range of risk-return profiles, and current perspective is of the view that it is very important that the equities held mirror that of the investor's risk appetite. In the investment world, we have a very famous saying of the higher the risk, the higher the return, and this is very applicable in the case of equities. Returns are not always guaranteed, as we have previously mentioned, with riskier equities having a higher variability of returns. Current perspective has thus created a risk-return continuum where on the left-hand side we have least risky shares, which are very defensive and generally pay better dividends, and on the right-hand side we have very risky shares that generally return a higher return for equity holders. Having a look at the graph on the left-hand side, we see companies like British American Tobacco or City Lodge that are not very risky and also have a very low return. And as we move up the scale to the right-hand side of the graph, we see shares like Standard Bank in the middle, which are more balanced shares that have a fair degree of capital variability, but also a fair degree of return. And finally, we have high growth shares, obviously, that are a little bit more risky. Before we delve into company specifics, I'd just like to point out two things. The first is that returns are based on capital returns, but also on dividends. And when we add these two together, we get total return. A lot of people overlook dividends, and I think it's one of those things that we should concentrate when we have a look at companies. Having a look at company specifics, we'd just like to go through the company profile that fits into each risk category. When we have a look at the cautious category, these are normally companies that are quite defensive. They generally pay a higher dividends of probably over 5% and generally have a low degree of capital volatility and would generally return inflation plus 2%. When we have a look at the middle of the road or a balanced profile, these are companies that have a good mix or a good balance between acquisitive growth and organic growth, and as such aren't high dividend pays, but would generally pay you a fair dividend between 2 and 5%. And finally, we would expect a capital return of inflation plus 2 to 5% with a low degree of capital volatility. And then finally, when we have a look at growth shares, these are high growth stories. These are companies that pay very low dividends as they retain profits in order to deploy it for acquisitive growth. And these are companies that have a high degree of volatility. And as such, we would generally expect capital return of inflation plus above 5%. This brings us to the valuation process, and there's two distinct processes that a person must go through. The first is the process of identifying good companies that have sound fundamentals, and secondly is the actual valuation process where we identify a price that is applicable for that company. It is very important to note that we will go through these different valuation techniques in later videos, but one thing that we must always realize is it is very important to identify the price of a company, because this generally tells us whether the company is overvalued or undervalued. Then we move on to what impacts return, and what is quite important is first and foremost what impacts return is the company's performance, and that obviously is the company's growth and the fundamentals within the company. Secondly, it's the market variation or market fluctuations. Current perspective have quite a good saying that the market is almost always incorrectly priced. It's generally the degree and the direction that it is overpriced that is important. Thirdly, economic conditions also impact returns. And then finally, as mentioned previously, the price that we pay for a company is very important. This impacts returns. Just to bring you to a little bit of a summary, the first point that we would like to bring up is that the equity asset class is by far the most complex and the most broad asset class. It is also the most risky asset class, but generally produces inflation-beating returns, which is very important. We would also like to point out that we fundamentally believe that the equities held in a portfolio should mirror that of the risk appetite of the investor. And finally, we should always be vigilant of the price that we pay for a company, because this has a major impact on the return profile. Thank you very much for watching this video. We welcome you to have a look at our website and our YouTube channel for other videos. And this video was proudly brought to you by Kerner Perspective and KP Fiduciary Solutions.